Welcome, everyone. I'm Matt Franklin, your portfolio coach, and this is Portfolios 500 Understanding the Market. In this lesson, we'll cover the basic definitions of markets, industries, and sectors, and provide you with some examples. From there, we'll get into monetary policy and talk more about the Fed and the Treasury and how those organizations work. Then we'll talk about FOREX, which is foreign exchange or currency trading, and we'll get into cryptocurrencies and how those work. Finally, we're going to introduce you to a couple basic economic principles that are important to understand when investing. We want to cover these topics because sometimes your portfolio will produce returns that are more based on market conditions, so it's important to know what indicators to monitor and how different movements will impact your investments. Getting into markets, industries, and sectors, all three of these can be a reference to both global and local concepts, but for the purposes of this training, we'll define them from the perspective of the stock. Depending on the subject matter, that may give way to different definitions for a market, and how we define a market is in reference to an economy or a group of economies, such as the United States, Europe, or things like the Eurozone or the BRICS nations. Getting into sectors and industries, we'll go through some examples in a moment, but with sector, it's really the area of the economy that a company is participating in based on their product or service offering. And some examples of sectors are consumer durables, energy, finance, and technology, and we'll get more into those in just a moment. For industry, it's really where companies are competing together with similar or related products, such as advertising, hotels, or even things like semiconductors. Industries are a little bit more about the product and who you compete with versus the sector, which is broader and more so a reference to the area of the economy that your corporation is participating in. Expanding on markets, this is just a reference to an economy or a group of economies. So in this picture, these markets are at a national level. Markets can also refer to the economy within the borders of a particular nation, or even something as small as a weekend farmer's market. More broadly, it can be defined beyond borders based on things like population density or shared cultural or religious beliefs. The reality is that the majority of the population lives in China, India, and across Africa. So when you see a map like this, it helps provide you with some perspective. Obviously, the population of Europe is quite large as well, and then you can see in the Americas how it's actually concentrated in only a few areas. You can also look at this through different trade zones, and in today's world, there are a lot of different trade agreements between nations trying to provide advantages for one another. These things are more dynamic than you might think, and NAFTA is on this chart, but that's already been replaced with the USMCA. And another thing to consider is that in addition to the USMCA and Eurozone are the BRICS nations, which were formed about a decade ago, which if you don't know, that's Brazil, Russia, India, China, and South Africa. And the reason that I bring this up is to point out that Brazil and Mexico are working on a free trade agreement currently, and if they're able to pull that off, in my view, you'll see the vast majority of global manufacturing move to those two nations over the course of the next 20 years, since they'll be at the center of those two major trading blocks. It's also worth noting that markets can be a reference to the marketplace where you're actually buying and selling stock, like the New York Stock Exchange. And I bring that up as another example just to show you that the term market can have a very broad definition, and it's really something that, depending on the person you're talking to, they could define it a number of different ways. But again, for our purposes here, the term market is just referring to an economy or a group of economies. Getting into industries, an industry is based on a group of companies that are competing together with similar or related products. These definitions can also get tricky. For example, I used to work in the travel industry, or at least that's what everybody called it. In reality, the travel industry comprises a variety of different industries. There's airlines, hotels, restaurants, and even advertising. And whether people realize it or not, the first credit cards came about due to travel. They were called traveler's cards, and it was just done as a way to help expedite transactions and not worry as much about certain exchange rates as you travel between countries. Then from there, you could also include services like EDP services or electronic digital payment services, and you can even get into traveler's insurance now. And if you look at our list of industries here, you'll find that the travel industry actually comprises a variety of different complementary industries, and none of them are actually called travel. We've segmented our reporting this way so you can break apart the different areas of the market and find what you're looking for. Say what you want to invest in is maybe gas and oil production, well, what you might find is another similar area of the economy like oilfield services might pique your interest. Or maybe you're more interested in biotech or pharmaceuticals, or perhaps you even want to invest in commercial banks or finance companies. The point here is just that there's a lot that's available to you, and to keep that in mind as you search through the stocks, trying to find the right ones for you. One thing that I'll tell you at this point is just to keep in mind that when you're searching through the investments that are out there, you might have a particular company in mind, and depending on your strategy, maybe they don't have the best grades. So while you might think that you've always wanted to invest in that company, what you can start to do is look at the industry and the sector that they compete in and look to see if there are other similar companies out there that may be better investments. Now, there are a number of times that I've thought I wanted to invest in a particular company, only to start to look at it and find out that there are better options out there in the same or similar industries. Now, if you want to be invested in a certain company, I don't want to discourage you from doing that. I'm just saying, if you're looking through all the information out there and you find better options, it's up to you which path you decide to go down. We just encourage you to use the industry and sector segmentation as another tool to help you search through the data and find what you're looking for. Now, that leads us into sectors, and a sector is the area of an economy that a company participates in based upon its product offering. So this is a little bit more of a broad brush and can refer to what a company does to interact with the market and generate their revenue. On the screen here, there are some examples of sectors. The company might provide basic materials or can be in basic industries like manufacturing. Or maybe they're a finance company or an investment house. So you can see here it's a little bit more of a broad stroke or bigger category that groups similar types of companies together. So with that, let's take our first break for a question. And this question is, what two countries in the middle of the USMCA and BRICS trading blocs are currently negotiating a free trade agreement? Is it A, Canada and India, B, Mexico and China, C, South Africa and the US, or D, Mexico and Brazil? Now, I briefly mentioned this during our discussion on markets, and the answer is D, Mexico and Brazil. And be sure to monitor that deal because it could lead to new areas of growth for the global economy. And it also reflects a growing trend by other areas of the world to move away from US and European controlled interests. Now that we've defined a market, let's get into market forecasting and monetary policy. Some of the key indicators to be aware of are the Treasury yield curve, the Federal Reserve federal funds rate, and the Fed's current rate projections. You'll also want to keep an eye on global exchange rates and understand why currency values are changing. Before we get into more detail on those topics, I just want to ask you about market forecasting. A lot of individuals don't have time to really look into this on an in-depth level, so what do? Well, just take a look at what the large banking and corporate institutions are doing with their money. Are they holding on to it? Are they putting it into investments? You can also look at the news and look into the financial headlines to see what are some of the big investors saying. Are they holding on to their cash? Are they investing it? Are they putting it in new ventures? Another point of reference is credit and how easy is it to get credit. So if credit is really easy to get, then the financial institutions likely believe that growth is on the horizon. In the same respect, if you go to the same institutions and they don't want to lend to you and you do have good credit, that's generally a sign that things in the economy are not doing well or that the outlook is not that good. So as you develop your financial acumen, just know that not everything is some math equation. Sometimes it's just about understanding your environment and whether or not it's the right time to jump in or out of certain investments. You can also reference a lot of podcasts and influencers to see what they're talking about, but remember that they're just speculators. They're not experts, so don't be surprised if their predictions are wrong. Predicting the market can be about as reliable as predicting the weather, and we all make fun of our local meteorologists for never getting it right. So don't be surprised when the market reacts differently than your expectations. Leveraging economics to help with your investments should make it easier to figure out where to invest and when to jump in and out of the market. And any good form strategy will include certain economic indicators that you monitor as a way to know what's going to happen next. In terms of timing the market and forecasting how and when to do that, once you understand how to monitor economic indicators and track monetary policy, the rest of it becomes predicting what type of year you think we'll have, and then aligning yourself with a strategy that benefits the most. To better understand how to do that, you have to develop an understanding of how different strategies perform over the years. And here's another snapshot of looking at that historical performance of our funds next to the S&P 500's performance from 2008 to 2020. And what you find here is that the market over time tends to do fairly well and is pretty consistent at producing returns over the course of a decade. However, there are certain metrics that in some years don't work out very well, and even when the market may be performing at its best. So all we're trying to get you to understand here in relation to market timing is that the strategy that you choose might have more to do with what's going on in the market and not necessarily be based on strictly your preferences. So it's worth noting that these metrics work better during certain market conditions, and that this table down here shows you the returns from each metric for each year. Then at the bottom, we've attempted to define the different types of years, so you can see whether or not each of the metrics performed well, depending on whether or not it was a growth year, a flat year, or some type of other market condition. One of the ways you can predict future market conditions is by paying attention to the Federal Reserve. They handle regional bank regulation and manage all of the central bank interest rates. There are 12 regional Federal Reserve banks that are located throughout the United States, and they are governed by the Federal Reserve Board, whose board members are appointed by the U.S. President. There are 7 of them, and they oversee the rules for regional banks. What they do is they work with the 12 regional bank presidents to set interest rate policy and manage how much currency is in circulation. They do that by buying and selling U.S. securities from the U.S. Treasury, and essentially what they're trying to do is to create controls that help regulate economic growth, stabilize exchange rates, and limit inflation. In terms of the U.S. Treasury, like we mentioned a moment ago, they supply the currency and handle government funding through the sale of securities. So the U.S. Treasury issues U.S. dollars based on securities that they purchase from the Federal Reserve, and then the Fed issues and repurchases those securities. They do this in an effort to manage and maintain how much money is out there. And then it's the interest rate that's paid out on those securities that are based on the federal funds rate, and that's determined by the Federal Reserve Board. Ultimately, what they're trying to do is align the interest rate policy with the type of inflation or deflation that they need in order to spur growth in the economy and to begin to get everybody moving again. Some of the controls, like quantitative easing, means that they need to buy back treasuries in order to limit monetary supply. And what they're trying to do is make the impact of an economic downturn minimal. If you think about it from the perspective that sometimes their actions may lead to millions of people losing their jobs if they don't make the right calls. So it's not an easy thing to balance, and there's no exact science to it, despite what some folks will tell you. Now, you'll always end up in market conditions with critics and people saying that things could have been prevented, but it's hard to tell, and these folks always try to do their best to coordinate with the Fed to produce favorable outcomes. Now, one of the main aspects of dealing with bond purchases is understanding the Treasury yield curve, which is a graphical representation of the current interest rate offerings. Essentially, what you need to understand is that there are a few different shapes to this. The shape is the ideal shape, and it indicates a healthy market by having the interest rates continue to increase the more time to maturity, meaning that the Treasury has a very strong belief that growth will remain strong in the future. Taking a look at this larger chart, going into 2018, the dark blue line, there was an overall positive trend in the economy. But if you go back to like July 2000, which is the red line, it's fairly flat, or even October 2007, the orange line, where it's actually inverted. Now, these are generally indications that something is up and not going well. And then when you see the inverted curve like February 2011, the green line, that's generally a sign that the overall economic outlook is not good and that there's not a lot of belief in the next few years. So, learning how to read this curve can be helpful in understanding when the market is entering or recovering from tough times. And generally, most investors reference this curve as an overall health indicator for the economy. Now, something else to be aware of when dealing with currency and banking are that the banks themselves can actually generate and create currency. Now, they do this through something called fractional reserve banking, and fractional reserve banking allows for banks to only hold on to a portion of their deposits. And right now it's set at 10 to 1. So what that means is that if you go to the bank today and you deposit $1,000, the bank is allowed to loan out $900 of that. They only actually have to keep $100. So before we go on to the next topic, obviously I can't just drop that on you without explaining it a little bit more. So let me give you a scenario here to think about this. If you have $10,000 in cash and you go and deposit that in your bank account, they only hold on to $1,000 of that. The remaining $9,000 they are not required to keep. So knowing this, you can begin to imagine some of the struggles that banks go through when there's a run on deposits. And it's one of the main reasons why banks fail and why FDIC insurance was created in the first place. So going back to our example, if they loan out the remaining $9,000 to another member of the bank, and that member decides to deposit the $9,000 and hold on to it from now, then the bank can lend out another $8,100. And if this process continues, suddenly a bank can create tens of thousands of dollars of loans while actually holding on to a fraction of the original value of their deposits. Problems then arise when the depositors come back and they need their $10,000. Say, for example, the individual is going to buy a car and needs to make a down payment. Well, when you come in to withdraw the $10,000, first the bank has to produce the physical cash for you, which they might not even have. Some banks even have rules where if you need over certain amounts of cash, you'll agree to give them time to produce the cash, and they aren't obligated to provide it to you right then and there. So it might actually take a while to acquire the physical cash, depending on how much you're requesting. The second thing you need to be aware of is that if the bank is now over-leveraged, then now the bank may no longer meet its cash requirements for the loans that they're giving out. So then they have to call in their loans in order to resolve their deposit issues. So if you have a loan with that bank, now there's no more 5, 10, or 30-year term. Now they need the loan repaid in full. And the vast majority of us aren't going to be able to repay everything in full at a moment's notice. Now you could always try to get another loan from a different institution, but if you tell the bank you can't repay, they have to start the collection process, book their losses, and start to write down their loans. So during poor economic conditions, this can really spiral out of control and cause banks and their customers to go bankrupt and lose everything. Now, the U.S. government, certainly they've established and they regulate FDIC insurance to provide guarantees for deposits up to $250,000. But that doesn't deter banks from taking on too much leverage. Now, no one wants to ruin their business, and bankers aren't doing this because they're greedy. Even in good economic conditions, what seems like a small earthquake might just be the makings of something much larger. And unfortunately, a lot of times you'll never see it until it's too late. Okay, it's time for our next question. And this one is a true or false question. So, true or false, you're sufficiently scared now and reconsidering why you even wanted to learn how to invest in the first place. I'm going to assume true, but don't let how the monetary system works scare you. It's out of your control, and all you can do is protect yourself by including alternative investments that hold value no matter the world's dominant currency. We've mentioned currency trading a few times, so let's spend some time explaining FOREX. FOREX is just an abbreviation for the term foreign exchange, which is just a reference to currency trading. Most of you might only consider currency trading when you're traveling to another country that uses another currency. And at its core, that's all Forex is. It's just calculating the different exchange rates and making a bet that one currency that you're purchasing today is weaker from an exchange standpoint than it will be in the future. With Forex, either you make your money that way or you can use it as a hedge if you believe that the currency of your nation is not stable. Now, as the basis for the exchange is just the exchange rate, and to calculate an exchange rate, you take the new currency and you divide it by the base currency. To determine how much you'd have in the new currency, you can take the base currency and you can multiply by the exchange rate. Obviously, this is a pretty simple and straightforward calculation, which can be deceiving because in terms of trading currencies, it can get complicated, mostly due to the quantity of currencies that are out there, but it's important to keep perspective on what's leveraged throughout the globe. Now, this here is a screenshot from Wikipedia, where you can see that as of April of 2022, 88.5% of all of the currency exchanged globally involved US dollars. The euro was second, encompassing another 30% of trades. Then you can see that's followed by the Japanese yen, the British sterling, the Chinese yuan, and then the Australian and Canadian dollars. The thing to keep in mind here is that if you're going to move money into another currency, just make sure it's a currency that you can also trade with and get out of in case it doesn't work out like you think it will. Sticking with more popular currencies is safer, but if you're looking to use currencies as an investment vehicle, make sure to start paying attention to geopolitics and global trade balances. Currency trading in general is not necessarily a way to make a ton of money, and I know there are folks that would totally disagree with me, but if you're new to investing, you're better off staying away from it, unless of course, you need it for a nice holiday or something like that. Now, I do know some individuals that come from international families, and there's definitely been times when they've been able to make their knowledge of the exchange rate benefit them. So just like anything else with investments, if you pay close enough attention to it, it can benefit you. But in general, currency trading is something that new traders should stay away from and take time before jumping into. For this program, we just want to introduce you to the subject. We don't really want to get a whole lot into it because there's so much from a geopolitical standpoint that goes into currency values that could be a whole nother lesson. Beyond typical nation-based currencies, a new type of currency has emerged over the last decade. When cryptocurrency first came out, it was a concept that I thought was really cool. It's a decentralized peer-to-peer fiat currency, which just means that it's got a floating value and it's only worth as much as people value it. There's also no need to control the supply, eliminating the need for organizations like the Fed and the Treasury. Now, obviously, that creates conflicts with the powers currently maintaining the status quo, which is why some governments are completely against them. Now, the currency gives the people control, and it takes control out of the hands of the bureaucrats, which is why I'm all about it. So let me explain why. Something you might not know about the US dollar and all of the currencies that were on that previous page is that they're all fiat currencies, meaning that they're not backed by gold. They're essentially backed by the hopes and dreams of their economy, and the values float based on the goods that are traded in those currencies. Cryptocurrency basically works the same way, except for that there's only so much created to begin with, so it's really demand and the types of goods being traded that props up its value. While processors do have the opportunity to generate small amounts by processing transactions on behalf of the networks, for the most part, you can't just create more. So that helps to offset future inflation potential by removing people from the equation so they can't fight over who controls it or how much should be out there. You probably saw this chart over here for the price of Bitcoin. And when I look at that chart, I feel like that's just representative of people losing faith in the market and the offerings that are out there. A lot of people have started looking for other ways to hedge against the market and to protect their savings. Others are looking for that get-rich-quick scheme and trying to find new ways to protect themselves against inflation. Personally, I think cryptocurrency is the future. It's just a matter of which ones ultimately end up holding value. A decentralized peer-to-peer currency to me is a really good idea, but it's still in its infant stages. And on a global basis, there are a lot of threats out there. So we'll see how it progresses, but this is certainly an area where you should pay attention. And if you want to find out more, there are a lot of good communities out there that you can learn from. My guess is that at some point in the future, this will probably be a topic that we have to expand on and provide more content. Now it's time for our third question. And this one is also a true or false question. So, true or false, Forex trading is easy and ideal for retail traders looking to diversify. The answer is false. Forex trading is risky and returns can be based on a lot of different geopolitical and economic factors. So, if you're not familiar with that, or if that isn't an area of interest for you, I would recommend staying away from Forex trading. One of the most basic elements of economics is understanding supply and demand. Supply is the amount of a good available to a market, whereas demand is the amount of a good needed by the market. When demand equals supply, then you have a market equilibrium and prices are competitive. Going a little bit beyond the basics, you also have supply side economics, where economists want little to no government interaction and encourage less regulation and oversight. Then there's demand side economics, where government regulation and intervention is encouraged to help support and control markets and market outcomes. Most politicians support a demand side economic outlook because it gives them the oversight. In economics, utility refers to the benefit you get out of a good or service. So, goods and services that work out well for you or provide you with value are really providing you with utility. Whether you understand utility or not, most rational consumers want to maximize utility to get the most for their money. And if you think about it, if you don't need something to last a long time, you're willing to spend less on it. But also, by spending less on it, you won't expect it to last long or to have much utility. Now, in the same respect, corporations will also want to maximize utility, and they can do this through investments and automation or by optimizing other areas of their business like their supply chain. No matter what part of the economy you're participating in, there's a natural drive to always maximize your utility. And keep in mind, this also means that corporations and governments are going to always find that price point where they can get the most out of you for the product or service offering. And if something gets to the point of being too expensive, the way you let a corporation know is by not purchasing that good or service. As sales decline, they'll adjust their pricing to recapture those lost sales. And if you still maintain your purchases, then you're signaling to the market and to that corporation that that level of pricing is acceptable for the level of utility being provided. Another consideration is classical versus Keynesian economics. And I don't want to get too into the different theories, but the basic difference is that Keynesian economists believe that it's the government's and the economist's job to intervene in the economy in order to try to encourage or curtail certain outcomes. This differs from the classical economists because they want to leave the market alone and let the market or the invisible hand do its thing. Getting a little bit more into the invisible hand of the market, essentially what it implies is that a market will self-regulate, which is an interesting concept, and you might not agree with that. Some people might want to know, what does it even mean to self-regulate? Basically, what they're implying is that if you make a bad product, the consumers are going to figure that out and they're going to stop buying them. And if no one buys your products, you won't have sales and you'll be forced to go out of business. So that's sort of the invisible hand of the market. It can be a good thing or it can be a bad thing depending on what's going on in the market. What I like about what it's implying is that it's saying consumers make rational decisions and provide competitive markets through freedom of choice, which is what we're hoping to help you unlock when it comes to stock investing, more freedom of choice. There are a lot of different ways that you can leverage these concepts. Another way you could view the invisible hand from is that each and every one of you are out there doing what you think is best and pushing for the changes that you think are necessary. And it's only by pushing for change that you're actually going to begin to see it. And you can use your investments to have a voice. Certainly, as a shareholder, you paid for your seat at the table, so don't forget to use it. Another aspect of economics that we don't hear a lot about anymore is antitrust economics. For those of you that are a little bit older, you might remember some of the Microsoft cases or even the Standard Oil case, which we're going to cover more here in a moment. Antitrust economics apply when a corporation becomes too large and controls too much of their industry or a particular sector of the economy. It's not good for consumers because they could now be receiving a product with lower quality and unfair pricing, where if there was a more free market, then consumers would have other choices and the industry would be pushed to advance and be more competitive. That reduced choice and consolidated control can create anti-competitive environments that can also lead to increased barriers to entry. So if you're a smaller firm trying to enter a market, antitrust actions would make it easier for you to participate. But anymore, we don't see too much activity in this area, and in general, large firms are being viewed differently today with policies like too big to fail. Now, that said, while you might be in favor of more government control over markets, you also have to understand that old saying, the road to hell is paved with good intentions. You might think that you're doing a good thing by trying to break apart a massive corporation, giving smaller companies a chance, but ultimately what you might end up doing is creating bigger problems because you got an outcome other than what you expected. And one of the best examples of this involves the story of Standard Oil and John D. Rockefeller. John started Standard Oil as a very ambitious young man and worked really hard to grow his company. He lived a fairly simple life and reinvested a lot of his profits right back into his company, especially in the early ages. That way he could grow as quickly as possible. So he continued down this path, and over time he was able to purchase a large number of oil refineries and continue to expand his holdings. He's even credited with helping to create gasoline itself. It was previously a byproduct from the oil refining process, and it was just being dumped into rivers and lakes. Of course, timing had a lot to do with his success. He already had a ton of control over oil production by the advent of the automobile, and as gasoline supply became a hot commodity, and that allowed for large amounts of capital to flow into Rockefeller's business. Eventually, he exerted a huge amount of control over the oil industry and even had leverage over the U.S. government. So due to some concerns by the government and due to industry complaints surrounding the pricing, distribution, and control of oil, the government stood up to Standard Oil in an effort to break up the company. And after some messy trials and some political theatrics, ultimately the government did win the case and John was forced to break apart his company. Now, what they didn't consider was that John was still the majority shareholder in all of the new companies. And at least from a monetary perspective, he ended up making significantly more by owning all the different corporations than he ever did by just simply owning Standard Oil. And while his wealth only grew, you could debate whether or not he still had as much control. All the new companies had boards, and all of the boards are elected to run the companies. Ultimately, his power as the main shareholder meant he could elect the boards too, but it probably was a lot more of an effort on his part to try and manage it all. And that just goes to show you that you might have good intentions, but that doesn't necessarily mean that you're going to get the right outcome. Antitrust economics are something that I've always been excited about and thought that it should be leveraged, but the problem is that it's not, and a lot of times when it is, it's not really leveraged in the right ways to end up with results that are actually beneficial. So over time, while I'm for the process, I've actually grown to be against too much government control and interaction, and I prefer to let the invisible hand work it out and determine the right outcome. Now, taking all of this in, you might start to wonder what type of politics all these methods support. Well, when it comes to economics, I think it actually simplifies political views. You might be surprised, though, that your economic views do not always align with your political ones. So don't be surprised if this slide challenges who you think you want to vote for the next time you're standing at the ballot box. In order to understand political and economic views, I'm going to show you something called the Nolan chart. And according to Wikipedia, the Nolan chart is a political spectrum diagram created by American libertarian activist David Nolan in 1969. This charts political views along two axes representing economic freedom and personal freedom. You can see the four quadrants here: conservative, progressive, libertarian, and authoritarian or fascist. And depending on how you feel about personal and economic freedoms, you might find that you don't fall on this chart where you were expecting. Now you might be wondering where I fall on this chart since I'm the one coaching you through all of this. And personally, I grew up in a fairly conservative environment, but became much more progressive when I went to undergrad and grad school. And when I first saw this chart, I was in grad school, and it was then that I realized I was much more of a libertarian than anything else. So here is where I believe I sit on the chart. I think I've always been on this centrist libertarian line here, but I've certainly moved back and forth between the conservative and the progressive spectrums. Ever since understanding where I fall, I've always seen that left versus right argument from a different perspective, and it's mostly made me feel like I don't belong to either party. And I don't want a large government or lots of government control, and right now there's not really a large party that represents those views. The reality, though, is that while you may not share my views, I think a lot of people right now do feel like they don't have a political party that represents them, and I hope that changes. Now, this might be controversial, but if I were to put a dot for where I feel the US government is today, I think they'd be here. Now, this is not a negative or anything, it's just my opinion, and my evidence is just that the government is large, their control is widespread, and currently their views lean to the progressive side. Of course, that could change depending on which way elections go, but as I record this, I believe we're here. One additional point that I think is interesting, there's a lot of negativity about fascists, and I just think it's interesting that fascists can lean left or right. I feel like sometimes people try to link them to party extremes within the left or the right, but in reality, like libertarians, they're their own group. Also, keep in mind that this chart was created in the 60s, and it doesn't necessarily represent all of the political and economic views. I just offer it as something to help you think about politics from an economic perspective. I don't have any agenda here. You're welcome to your beliefs, and how you vote is your right, and I'm not trying to influence that. I've brought this up a few times already, but it deserves to be covered again. Capitalism certainly is not perfect, but it's responsible for creating a substantial amount of wealth for people that would not otherwise have access to it, and it's brought considerable benefits and freedoms to the world. One of the best parts about the system is that your money becomes your voice, and your purchases reflect your preferences rather than just necessity. Now that leads to more variety and more freedom of choice for consumers. That helps to create competitive markets, and in competitive markets, the price you're paying for your goods generally reflects the market equilibrium price that we discussed a few moments ago. And in a healthy market, if you don't like something, you don't have to support it. All you do is use your money to support the products and services that you want to see and avoid the ones that you don't want to support. Now, if people choose to use their money to support those products, then there's still a market for it, but you don't have to participate in it, which is okay. You can't control what other people do, and we all have to compromise sometimes. So spend your money on the products and services that you want, and that will help to produce the economy that you want to see. Now, in terms of measuring economies, there are a lot of different economic indicators out there that you can refer to. They can help you measure outputs and forecast how a market is going to perform. You can look at gross domestic product. You can take a look at the central bank interest rates. There are a lot of different currencies out there and debt associated with the governments behind those currencies, so that's something worth paying attention to. A lot of areas around the world will maintain a consumer price index, and understanding the affordability of goods will help you predict economic outcomes. As well, different infrastructure investments should be paid attention to, and understanding a nation's ability to follow through on those things. There are a lot of wonderful ideas being shared today, and while some of them are really cool, you also have to make sure that it's more than just an announcement and that the nation has the ability to follow through on their investment. Then you want to look at things like income per capita and how that's growing over time. You'll want to take a look at worker education levels, and you may be surprised at what areas of the world have a workforce that's more oriented towards direct labor versus skilled trades, or maybe even having a more services-based economy. But by understanding different worker education levels that are already available in different areas of the world, that can help you understand why a corporation might expand in a certain area of the world and make different types of investments in different nations. Now, consumer confidence is another great indicator, as well as the unemployment rate. Unemployment rates can change quickly, but in some areas of the world, they can be pretty consistent. It's worth taking a look at, and of course, everybody wants it to improve, but sometimes it's more of a cultural thing than an economic indicator. You'll also want to monitor birth rates of different nations. Birth rates have always been indicative of economic growth, And the vast majority of growth over the 20th and 21st centuries happened after we've seen large increases in birth rates. Now, from the same perspective, negative or flat birth rates might actually be indicative of slowing or stagnant growth. Ultimately, you just want to have an awareness to all of these different economic measures, and if you're trying to figure out what's going to happen next, chances are looking at some of these will help you figure that out. Okay, that about wraps it up, but how about one last question before we go? What is the measurement that tracks total economic output? Is it A, income per capita, B, the unemployment rate, C, gross domestic product, or D, the consumer price index? Now, we just covered this. The answer is C, gross domestic product. GDP is one of the most important economic indicators that you can monitor, but it's just one of several that you should be paying attention to. So there you go. That's an introduction into understanding the market. Hopefully that provides you with a little more information on markets, industries, and sectors, as well as the regulatory agencies and controls that are at play and can impact the market. Monetary supply and exchange rates are something that need to be monitored, as well as different economic indicators and currency values. Now, it's a lot to consider, so don't overwhelm yourself. Just pick one topic at a time and slowly try to understand more. Be sure to stay tuned for our next lesson, Portfolio 600, where we'll cover how to get started trading and some of the final things that we want you to be aware of before you make your first trades. Until next time, I'm Matt Franklin. Thank you for being here, and have a great day.